I'd like to take you back to March of this year, 2020, which feels like eons ago. Due to fears of COVID spreading globally, governments in the US and around the world imposed strict lockdowns in place and shelters, thereby putting the economy into a deep freeze. Certain industries were decimated. Overnight, revenues evaporated. Industries and sectors that were most affected include consumer-related ones such as hospitality, travel, lodging, gaming, airlines, retailers. Energy sector was badly affected as well due to consumers not traveling in their cars or by plane. During these fears and flight to quality, interest rates fell sharply while credit spreads rose dramatically. In investment grade, spreads, which started the year at around 100 basis points, widened to 375 basis points, while in high yield, spreads, which started the year at around 300 basis point spread, widened all the way to 1,100 basis points. Within a matter of days, market liquidity dried up as there was indiscriminate selling and a mad dash for cash. Companies across numerous industries having their revenues drying up overnight and unable to pay their suppliers and their employees tried to raise cash in any way they could, aggressively tapping their credit lines. This further pressured the financial system. Seeing the financial carnage that was occurring, the credit rating agencies started aggressively downgrading billions of dollars of corporate debt from investment grade to high yield, further exacerbating the financial pressures. With companies desperate for cash and the economy reeling, credit rating agencies downgrading indiscriminately, the financial system was on the verge of collapsing. Seeing this, the Federal Reserve Bank of the US, as well as many other central banks around the globe, pulled out their playbook from 2008 and started aggressively applying quantitative easing, buying billions of dollars of Treasury and mortgage-backed securities on their balance sheet. With funding from the Congress and the US Treasury, the Fed invoked some other programs that they had never done before, including buying corporate debt. Crucially, this provided a strong signal to investors that the Fed was there to provide any support possible and open up the liquidity of the financial system and avoid an economic collapse. Within a matter of days and weeks, the credit markets opened up as investors were more confident that the system would not collapse, and they started aggressively buying corporate debt, reversing what they had done just a few weeks earlier. This led to a wave of massive new debt issuance as companies raised a record amount of credit to put on their balance sheet and extend the term loans that they had taken out earlier, thereby putting off any solvency risk during the pandemic.
In mid-March, it felt like we were running a triage center in credit research. It sort of felt like the sky was falling and your hair was on fire. So what we did is provided some guidance to our credit research group how to prioritize their time as we were all processing the global economy shutting down for some period of time. So we instituted a few different analyses. The first thing we did was the risk bucketing exercise. So we asked each analyst to place each issuer into one of four buckets. One was the default restructuring bucket, and then high risk, medium risk, and low risk. And we differentiated those definitions between investment grade and high yield. So for example, in investment grade, high risk meant that there was a greater than 40% probability that this issuer could be downgraded to below investment grade. In high yield, high risk meant that there was a greater than 40% probability of this issuer being downgraded into CCC. So the analyst did this exercise, and then we provided all of this analysis across developed markets and emerging markets to all of our investment teams, and we were publishing this about on a weekly basis. In addition to the risk bucketing exercise, we were also updating our downgrade forecast with a specific focus on the BBB part of the market. We had been analyzing this part of the market for some time, just given the expansion of BBBs over the last few years. What we've been doing pretty much on a monthly basis was each analyst was assessing the probability of their BBB issuers being downgraded to high yield under a recession scenario. Well, fast forward to March of 2020, there was a significant increase in the probability of fallen angels. So each analyst was updating this list to assess the number of issuers in the debt outstanding that would likely be downgraded to high yield during the current recession. And again, we were providing this analysis to our investment teams on a weekly basis. We also were laser focused on liquidity during this time. Now, certainly there were some industries that would be more impacted under this downturn. For example, industries such as airlines and gaming and lodging and some retail. The investment teams and the analysts were laser focused on how companies would be assessing and managing their liquidity through this unprecedented time. So each analyst was doing a deep liquidity analysis on their issuers, focused on what is their current liquidity, but also what are their future liquidity needs over the next, say, 3, 6, 12 to 24 months. So what this meant is we'd be looking at the cash that's on the balance sheet. How much availability does each issuer have on its bank lines? What are the near-term debt maturities? Are there any key covenants that might impede debt issuance going forward? And given the downturn, we were focused on understanding the impact on earnings and cash flow generation, as well as cash burn rates. And certainly we were concerned about those companies that might need external liquidity. And then turn to April and May and June, when there was record new issuance as the investment grade spigot just opened up. And we found that issuers were tapping the investment grade market and then the high yield market at really attractive rates, all-in rates, just given the historically low treasury yields at the time. Now, this was very different than the 2008 and 2009 time period when basically the new issuance market had shut down for a period of time. In addition to these analyses, we felt that communication is really critical during times of immense uncertainty and volatility. Our analysts were focused on actionable insights and actionable ideas that we can share with our investment teams. So we did targeted outreach to each investment team to understand what their priorities and needs were. And everyone was focused certainly on liquidity. Some groups that were investing at the higher end of the risk spectrum were focused on things like, what is the enterprise value under the downside case? Where does the debt sit within the capital structure? What are the key covenants that we need to be aware of? And certainly any near-term maturities that were coming up. Other teams were focused on what are the assumptions that you're using for this downside case? And still others were focused on understanding what do the analysts recommend during this time? What are we recommending buying, adding to? What do analysts recommend selling, or just completely avoiding altogether? And then some teams really wanted to understand what are the rating agencies going to do, especially in the investment grade market with companies that might be at risk for downgrade to high yield.
The combination of the huge volume of new issuance as well as the credit downgrades has dramatically changed the composition of the corporate bond indices, both investment grade and in high yield. With a huge amount of new supply and dramatic downgrades of credit ratings, the composition of the various corporate bond indices has changed dramatically. In high yield, the index is now more tilted towards higher quality BB, as several large fallen angel downgrades have occurred over the past several months. Within investment grade, BBBs had peaked at over 50% of the index. With some of the downgrades to high yield, BBBs, the lowest quality within investment grade, now total roughly 48% of the benchmark. This is known as survivor bias. As a result of these index changes, we think that clients should be mindful of these when they think about their asset allocation and their risk tolerance and their investment objectives. In the 10 years since the global financial crisis of 2008, we've seen dramatic growth in the BBB component of the investment grade bond market. This is in both volume and percentage of the market. We believe there are many factors driving that growth in BBBs, including persistent low interest rates, investors' desire for higher yield and willing to go down in quality to achieve that higher yield, companies being more aggressive in mergers and acquisitions and in stock buybacks. In sum, BBB has become a sweet spot for issuers. With the dramatic growth in BBBs, in 2018, late in the credit cycle, investors started getting concerned about what impact the size of that BBB market might have in the event of a recession. Several Wall Street firms issued reports raising these concerns, and highlighting that the high yield market, if there were a lot of downgrades, would be unable to absorb all the BBB downgrades. At Loomis, we did our own analysis to assess the risk of BBBs being downgraded to high yield. Our analysis showed that the risk of BBB downgrade to high yield was lower than many of the published reports. Some of the reasons that we thought the risks of downgrade were lower was the resiliency of a lot of the companies, the large companies who had issued a lot of debt over the past 10 years. We believe they have more financial flexibility to cut back on their stock buyback programs, do asset sales, and because of the free cash flow that they typically generate. COVID-19 hit us in March of this year, and the recession was much worse than we feared. Many of our analysts aggressively downgraded their own internal ratings, as well as raised their expectations of downgrades by the rating agencies to high yield. In fact, our forecasts of downgrade to high yield increased from approximately 9% or $300 billion in January to 17% or about $550 billion by March, and all the way up to 21% or $650 billion by mid-May. Since then, our analysts have stabilized their downgrade forecast due to several factors, including raising more liquidity on the balance sheet, cutting costs, and staving off any solvency issues for at least the next several quarters. We believe several sectors and industries still remain vulnerable to credit stress and deterioration. Their path forward will be very much dependent on the coronavirus, testing, vaccines, et cetera, and whatever consumer attitudes and behavior are around spending.
Demand for gaming, lodging, and leisure-related industries came to an abrupt halt when lockdowns came into effect in late March. Initially, companies drew down their revolvers, furloughed employees, and cut their dividends in an effort to preserve cash. The government provided its first round of stimulus in the form of PPP loans, which many lodging owners took advantage of to cover payroll expenses and pay management fees. Now that companies have reported second quarter earnings, we're getting a better sense of what a rebound may look like, where it may take place, and what monthly cash burn may look like from company to company. Thus far, China is leading the recovery, with hotel occupancy levels reaching 60%. Pre-COVID, a normal occupancy rate was roughly 70% in Greater China. U.S. lodging demand bottomed in late April before rising through June and plateauing again in early July as COVID cases spiked around the country. Leisure travel is leading the rebound, and we're seeing extended stay and limited service hotels outperforming full-service hotels. Drive-in markets are also faring much better than large urban areas. We're also seeing some positive data points in the U.S. As expected, we saw a wide variance in U.S. occupancy depending on the hotel category. For instance, hotels in suburban drive-in markets fared better than those in big metropolitan areas. Demand was driven almost solely by leisure travel, and companies levered to corporate business travel fared the worst. Among the companies we follow, occupancy ranged anywhere from 12% to 60% in the first 3 weeks of July, depending on these factors. As we look into the third quarter and second half of 2020, there is still very limited visibility around occupancy and room rates, but it appears as though business travel is essentially dead for the remainder of the year. Management teams are focused on liquidity and cash burn, as well as health and safety protocols for their staff and guests. A key risk to the industry would be another spike in national COVID cases, prompting governors to lock down their states in the fall or winter. Pivoting to gaming, operators are under significant pressure in both Las Vegas and Macau as they reopen their facilities subject to capacity restrictions. The gaming industry was negatively impacted by the same factors that affect lodging companies, COVID-related closures. COVID cases in the U.S. peaked in April, improved, and then started to rise again in late June and early July. Since March, we have downgraded almost every company in our gaming coverage, and the vast majority of issuers continue to carry negative outlooks. We believe 2020 is a toss-away year, and bond prices reflect an eventual recovery in 2021, predicated either on the containment of the virus or an eventual vaccine. In the U.S., 88% of commercial casino properties are now open with various restrictions by state. Nevada casinos opened 7 weeks ago at 50% capacity, and bars have already been closed again as COVID cases are spiking due in part to visitors from California and Arizona. There is speculation in the market that Las Vegas may close again. That being said, states rely heavily on tax revenue, so reshutting casinos will be problematic from a fiscal perspective. In Macau, while there have been baby steps to loosen travel and quarantine restrictions on the IVS or the individual visit scheme and group tour visas will need to be lifted to see any meaningful rebound. There is no set timetable for this. There has not been any noticeable uplift in Macau VIP business, despite the recent relaxation of a 14-day quarantine on Guangdong province arrivals from Macau. Companies have mostly reported their second quarter 2020 results. This is giving us a good glimpse into what the rest of the year may look like. U.S. gaming operators saw unprecedented top line and EBITDA declines, and the only companies spared were the gaming REITs. Operators are effectively flexing labor, appealing to their highest margin customers, and eliminating full service amenities to boost margins and reduce cash burn. We believe that online wagering, iGaming, and lottery have been bright spots, and operators are seeing pent-up demand. However, this is also partially driven by stimulus money. Regional gaming companies are outperforming Las Vegas-centric companies, which was expected. Going forward, we should see a continuation of this trend as Las Vegas is one of the largest convention markets in the country that depends on corporate business travel and a large portion of passengers arriving by plane. Liquidity profiles vary greatly, with runways of 10 to 84 months. Every company was able to access the capital markets, and over $6 billion of capital has been raised in the space. As we look into 2021, visibility remains poor. However, we believe that estimates will be much better than 2020, but still well below 2019 levels.
Since March, we've seen an unprecedented decline in airline passenger traffic. The U.S. airlines reported that airline passenger traffic was down 95% in the second quarter, and airline revenues were down 85 to 90%. While the U.S. was beginning to see some recovery in demand from the April lows, the pace of the recovery stalled in July as COVID-19 case levels increased in the U.S. and as both domestic and international travel restrictions were put in place. The CARES Act program thus far has provided $22 billion in aid to the U.S. airlines, with more aid agreed upon in the form of secured loans. The government program by itself is not enough to offset the decline in revenues. In this environment, the U.S. airlines have focused on raising capital to improve liquidity and reducing operating costs in order to limit cash burn. The capital markets have been open to the U.S. carriers, with the airlines raising $56 billion in capital year to date in the form of debt and equity issuance, sale and leaseback transactions, and forward mile sales. In our opinion, the liquidity picture looks much improved since March. However, we still have concerns about the level of debt these companies have taken on. IATA is forecasting a recovery to 2019 passenger traffic levels will not occur until 2024. In this environment, several airlines have stated they expect to be smaller in a post-COVID world. However, this option may not be available to airlines with a heavy debt load. Our outlook for the airlines is negative. While we expect the level of cash burn to decline as the year progresses, the pace of recovery is uncertain, and we expect any recovery to be a multi-year process. In this environment, we see the possibility of further ratings downgrades from the rating agencies. We also believe that bankruptcy risk has diminished significantly for 2020. However, we cannot rule this out going forward, particularly for more highly levered airlines. In our opinion, liquidity is adequate for 2020 and well into 2021, at which time we would expect a recovery to begin to take shape. Demand for aircraft has fallen off sharply with the decline in air travel. Similar to the airlines, a recovery is expected to be a multi-year process. Business models for the aircraft lessors are more resilient, in our opinion, given the presence of longer-term leases. However, we have concerns about customer credit quality, particularly as airline bankruptcies increase globally. In this environment, the lessors are providing rent deferments to their airline customers, and the cash collection of rents is something that we are tracking closely. On the plus side, the lessors have been able to reduce CapEx and access the capital markets in order to enhance liquidity. The credit outlook for the aircraft lessors is also negative. We expect airline bankruptcies will negatively impact aircraft utilization and impact aircraft lease rates going forward. We also believe that asset impairments could be forthcoming given declines in aircraft valuations. In this environment, we favor the larger, well-capitalized lessors over their smaller competitors. In our opinion, the smaller lessors are at a disadvantage given less access to capital and may be less skilled at releasing aircraft. We also favor aircraft lessors with newer portfolios as we believe they may be at less risk for future impairments. Retail REITs have been one of the most impacted segments of the REIT market to the COVID-19 pandemic. Mall and strip centers have been impacted as state and local ordinances have caused many property types to close. Grocery and other essential good tenants have fared much better in this environment, while property types such as movie theaters, restaurants, and entertainment-based retail have fared much worse. Rent collections have varied significantly by property type. Since April, rent collections have improved dramatically. However, we still have a ways to go. The credit outlook for REITs is less negative, though challenging nonetheless. Mall and strip center retail REITs will have to contend with an increase in retail bankruptcies, and filling vacated space could prove more difficult. In this environment, we expect negative rating actions to outnumber positive rating actions. However, we do not expect wide-scale rating downgrades. Fortunately, REIT balance sheets were well positioned prior to the current downturn, with leverage often at lower levels prior to the global financial crisis. REITs have also been less reliant on shorter-term debt. REITs have been able to access the capital markets and often been able to extend their debt maturity profiles.
A&D stands for Aerospace and Defense, two separate industries. One is driven ultimately by the consumer, while the other is driven by national security concerns. Aerospace generally refers to commercial aviation equipment manufacturers, OEMs, as well as their supply chains. Products include jets we board at airports and business jets that high net worth individuals and corporate executives travel on, as well as all of the components that are manufactured by downstream suppliers. Defense companies are involved in products that support national security. Products in the space include military jets, tanks, combat vehicles, missile systems, and the like. The defense industry has had a much more muted impact of the COVID pandemic than the aerospace sector. Defense companies, for the most part, remained open during the initial phases of the COVID pandemic. They did experience delays in the supply chain, and these were due to transit difficulties and some suppliers being forced to close due to local regulations. They also experienced costs for the deep cleaning and social distancing protocols that were implemented at all firms throughout the U.S. The federal government stepped up support for the defense complex during this period. Support came in the form of accelerated payments for products from the defense industry. Aerospace, on the other hand, was severely impacted by the COVID pandemic. Commercial traffic dropped 95% in April and has only recovered to being down 60% year on year in July. For context, historically a bad year was considered to have traffic drop 3 to 5%. We are truly in an unprecedented period. Commercial jet customers, in response to the demand erosion, have been deferring and canceling orders, which has driven the OEMs to lower production rates, which has rippled through the supply chains. The lower rates have driven layoffs of tens of thousands of people, caused sharp reductions of profitability and cash flow, and has led to a number of credit rating downgrades. Some of the areas that I watch to monitor short and long-term trends within the commercial aviation space include the International Air Traffic Association, IATA, forecasts for both domestic as well as international flights. Domestic travel recovery will support demand for narrow-body jets as well as regional jets, while international travel will support demand for the much larger wide-body jets. I also watch for comments out of the commercial jet customers regarding ordering intentions, fleet composition plans, as well as monitoring their credit quality is important to ensure that the customers can pay for the deliveries as they come due. Monitoring credit quality involves staying current on my colleague Jim Barr's thoughts on the sector, as well as watching credit agency moves. And it's obviously important to monitor the OEMs and their suppliers' intentions for production rates, their ability to access the capital markets, their ability to follow through on their cost-cutting plans, and their ability to preserve liquidity during these trying times. On the defense side, I monitor Department of Defense budget, DoD, as well as federal deficits and program awards. The 2020-2021 period is going to be a very interesting time to monitor these factors. COVID has had a material impact on the deficit due to all the stimulus measures. At some point, these measures have to be paid for, whether it be tax rate changes or shifting budget priorities. Under a Republican regime, I would anticipate the Department of Defense budget being relatively stable at the currently high levels. While under a Democratic regime, I would expect modest cuts to the Department of Defense budget as other budget priorities become more important. Using the IATA forecast as a baseline, domestic traffic is expected to recover to 2019 levels in the 2024 timeframe, plus or minus, with international traffic following by a year or two. Broadly speaking, this forecast is consistent with other projections from other industry participants. That said, my expectations for recovery are in line with that plus or minus 2024 recovery timeline, although I do expect some volatility along the way. Volatility could be driven by an increase in COVID cases or perceived effectiveness of the COVID vaccine when it comes along, as well as other factors that would normally impact commercial air travel. As the recovery takes hold, and more importantly, conviction around the recovery takes hold, I do expect the OEMs and suppliers to raise production rates modestly. Overall, I do expect this to be a slow and multi-year process.
Sharp drop in oil prices and demand has been devastating for the energy companies that we follow. OPEC's decision to flood the market with oil in early 2020, followed by the COVID pandemic, led to even negative oil prices earlier this year. While prices have recovered, they're still not to a point where energy companies can make money. They're doing their best to survive. The company's already been through a downturn in 2015 and 16 in cutting as much fat as they could off their cost structures. It was hard for them to react and reduce costs in order to meet the falling prices. Energy companies have done their best to survive through accessing the bond market and shoring up their balance sheets. But the high-yield entities don't have much of a choice but to restructure, as the low oil prices has forced leverage to spike and cash flow to go negative in some instances. While we've seen the market open for the investment-grade companies, where companies are able to issue debt in order to shore up their balance sheets and ensure their survival, the high-yield market is closed to all but the strongest of entities. The equity market is also not there, as we've seen years of equity capital thrown into the industry and simply burned. Right now, we focus on companies with limited near-term maturities, natural gas companies that benefit from the sharp fall in oil production, which will then lead to the sharp fall in associated gas production. As we look to the future, we focus on companies with the lowest cost structure and the strongest balance sheets, as many of the high-cost producers will go away.